Hello everyone and welcome to your Glassnode video report for week 38. I'm your host Checkmate and we're recording this on the 21st of September 2021. Now this week we're actually going to do a little bit of a break from tradition. Some of you, the astute in the audience, have noticed that yes, I am Australian from the accent. Did it give it away? Now what I want to highlight is that when the newsletter went out on Monday, our written report, this was actually prior to seeing the red candles that I woke up to. So what we're going to do in this week's newsletter is cover not only what we did in the written report, but we're also going to touch on some of the mechanics and some of the behavior that's occurred in the last 24 hours to try and characterize what's going on with this downside price action, which is something that seems to be affecting the macro landscape we're seeing across equity markets and uncertainty across a number of global markets at the moment. So Bitcoin is just one of those. So what we're going to look at this week is the current sell-off. We'll start with that overview and we're going to go down into some hourly timeframes and really look at some of the detailed data on what's been going on over the last 24 hours. That's then going to flow into looking at our long-term holder spending and the realized profit and loss. We really want to look at who is actually spending during these major events. We're going to look at our exchange balances and how that's actually been affected, whether we've seen a change from the dynamics that we wrote about on Monday. And then we're going to look at the Thermocap and some block subsidy models, which is a very interesting type of valuation model that is based on the cost of production or the assumed cost of production for Bitcoin. So let's get started with our analysis. We'll jump across to Glassnode dashboards. So here we are in Glassnode Studio. We're looking at a week Onchain 38 dashboard. And as I noted in the intro, this red candle was actually a surprise to me when I woke up. So we were asleep over here on this side of the world. But what we're going to look at to open up is really understand what's happened as this sell-off has taken place. So what we're seeing is some uncertainty in macro markets that is naturally spilling over into the crypto space, into the Bitcoin market, and we're seeing that there's this risk-off behavior. Now, what we saw, I've got two charts here to start off. We've got our futures open interest in perpetual markets. So this is how much leverage or open contracts there are in these perpetual swaps. And we've also got the funding rate, which is the interest rate that is paid. If it's green, it means that longs are paying for the privilege. They're paying an interest rate to be long on leverage, and they're paying that to the short side. And conversely, when it's red, it's showing that the shorts are paying longs. Now, what I want to just really highlight here is the difference in character between what we saw in the 6th or the 7th of September, when we had this very significant flush out of about $4 billion worth of leverage. It was a very substantial flush in essentially all clear within an hour. You can see this near vertical cliff where all of these contracts were essentially flushed out. Now that's demonstrating that the market was generally surprised by this event. People were not closing out their contracts. Everybody was going long. We talked about it last video. We actually had a short squeeze followed by a long squeeze. So people were essentially on the wrong side of that trade. Now note the difference in the current environment. As we're getting this selling off pattern, this waterfalling down of price, we're seeing a gradual reduction of leverage. And what I also want to highlight is note that we formed this stable base after our 6th of September sell-off. We've more or less closed to just down below that level, but really we built up this extra leverage, we've then closed it back down. Now note also that over this same period of time, let's zoom into 1 month, you can actually see that our funding rate has been slowly declining. It's been in this gradual reduction, which is actually showing that people are taking less and less and less leverage. So this, to me, you can see the change in character between these two. Let's again zoom into 1 month. You can see that this change in character is showing that this was a surprise where the market was actually flushed out, cascading leverages, stop losses got triggered, that stop loss became somebody else's stop loss. Whereas this is actually more of a controlled selling. It's actually people closing out because of this risk-off behavior. It shows that people are probably more aware, traders were more aware of this risk, and as it started to materialize and markets started to sell off, traders started reacting by closing out their position. So it was less of a surprise liquidation and more of a sustained or controlled sell-off. So that's, in terms of the character, this was unlikely or less likely to be driven by like a cascading liquidation in the crypto space. It's showing that there's actually a whole lot of, there's other forces at play that really were behind this move. It's more of a macro environment and the traders are essentially reacting as the new information comes in. And now we're going to move into a bit of a blend. So we're starting to move into what we covered in the newsletter, but I want to open with our ASOL metric, average spent output lifespan, and dormancy. Now, the reason that I'm looking at these two is because it's good to see when we have these sell-offs, how did the market react? And in general, those who are here for that long-term, the overall long-term view of what Bitcoin is doing, generally we want to align ourselves with the smart money. Now, the smart money tend to be people who have seen this volatility before. They've been in this market for a long time. And what that generally, the tool that we normally use to characterize these investors is lifespan, or how old a coin is since it was last moved. Now, average spent output lifespan is looking at all of the transactions. How old were they? It doesn't care about how many coins were moved or what the volume of BTC was. All it cares about is of all of the UTXOs that were spent, all of the outputs that were spent on chain, how old were they, and what is the proportion or the average age of those particular coins. Dormancy then does look at the actual volume that's moved, and it looks at the average age per unit BTC, per unit of coin that was actually spent. Now, what we want to see in these downdrafts, or when you're tracking the smart money, you can see that we have distributive behavior when we get these uptrends. So ASOL was trending higher, Dormancy was also trending higher during the first phase of this bull market. That's demonstrating that hodlers with old coins, smart money investors, people who've been here for a long time, were spending and taking profits on the rally higher. Now, the converse is also true when we're seeing a downtrend, which we saw in May, and what we've actually seen over the last couple of days, and the last 24 hours is no exception, we've actually seen a downtrend across Dormancy and ASOL. So we're getting agreement between both of these metrics that by and large, the coins that we're moving are actually relatively young. They're not older coins that are on the move. It's generally showing, now that doesn't mean that they're not old coins are being spent, there will be some, but it's showing us that we're not seeing a huge spike higher where all of these old coin holders are saying, that's it, it's time to exit the market. So it's showing that at the very least, and again, the data can change, we can see this evolve over time, but as of the data at the time of recording, we're essentially seeing that most hodlers are kind of sitting tight. And that's not dissimilar to what we saw in May, where we had this major sell-off down 50% in a matter of 2 days, and we actually saw reducing average age of the coins being spent. So it's showing that that conviction to stick around continues to be there. So what we can also then look at is the net realized profit and loss. So what we're looking at is for every coin that was transacted, what was the last price that it moved at? And therefore, if it moved at a lower price, it's going to be in profit. If it was last purchased up at the all-time high at 64,000 and was then spent, it's going to realize a loss. Now, what we can see here is that over the last 24 hours, we actually dropped down into a net loss. So more of the coins that were moving were actually from a price that was higher up than where we are at the moment. We can see this on our adjusted SOPR. So SOPR is a very similar metric. You can see that the pattern is actually quite similar to what we have in the net realized profit and loss. So adjusted SOPR is looking at the entire market, all of the coins that are moving, ignoring coins younger than 1 hour, which are normally a relay transaction. So it's looking at most of the economically meaningful activity. When it's trending higher, profits are being realized, and we saw that profits were realized as we rallied higher, shows that there was enough strength to absorb those coins. We've now broken down below a value of 1. Now, this doesn't necessarily mean that we're trending back into a bear market or that things have ended. You can see that sometimes we get these red candles, but it also is a sign that there are losses being realized, and that can signify there's a little bit of pain, a little bit of panic in the market. Now, you can see that during the May period of time, that actually extended for a longer period. And that's when we start to see more bearish price action. When again, there's sustained losses being realized, it's showing that there's pain, there's people who are losing money in the market, and that generally leads to a more protracted bear market. So what we're generally looking for is how does this respond? We've seen that there's some losses being realized. It means that coins that were last spent were essentially from either in the all-time high or from the recent local high. So they're essentially coins that were last moved higher. On net, most of the coins moving are at a loss. The question is, will this be sustained over the next couple of weeks to maybe even months? On our spent output age bands, we can see that there's been a little bit of an uptick of these older coins being spent, but not to a huge extent. And particularly over the last 24 hours, we're actually seeing these darker purple colors really not come back to life. So what we're seeing is most of the transaction activity tend to be these coins that are a couple of months old, and those couple of months old coins represents these losses. In order for a coin to essentially be moved at a loss, it has to have been bought up in the all-time high zone, this 50, 60,000 range. So this goes back somewhere in the order of about 6 months, or in the most recent period of time. So we're talking about relatively young coins. There's a couple of long-term holders in there, but overall, we're actually looking at relatively young coins that are spending at a loss. Now, another interesting metric is our long-term holder SOPR. So whilst the adjusted SOPR you can see tends to oscillate around a value of 1, which is more or less saying you can see our boundaries here is about 1.2 at the upper end, 0.9 at the lower end. That's saying that roughly minus 10% to plus 20% is the kind of profit or loss range that coins are normally moving in. Across the whole market, people are normally moving their coins plus or minus 10, 20%. Now, with Bitcoin, because it has had such an exponential price rise, people who hold their coins for longer periods of time can generally realize larger profit multiples. So rather than 10% loss, 20% gain, if you note the long-term holder SOPR, the y-axis is actually more in the whole number territory. We're talking about numbers greater than 2. Now, a value of 2 means that somebody realized a 200% gain on their coins, which means if the price is currently 40,000, that means that they withdrew their coin from an exchange at 20,000. So we can actually start to develop an idea about what the cost basis is for these long-term holders. Because they have these large aggregate profit multiples up the top here, you can see they were realizing somewhere between 800%. These are coins that were accumulated, down at 5,000, 6,000, that are being spent up at the all-time high, 50, 60,000. As we've started to trend down, right, essentially since May kicked in, we had this volatility to the downside, and particularly during this rally, note that we've got a lot more volatility. It was actually quite smooth in terms of the rally higher. People are gradually selling their coins. You're getting kind of this structured, strategic selling on the way up. As we trend down, things start to get a bit more volatile. Now, that volatility in long-term holder SOPR is actually showing us volatility in people's cost basis. Because if they're realizing a 115% one day, 250% the next day, those profit multiples, when price is not necessarily moving a great deal, it's showing that the cost basis where those coins on aggregate are coming from is actually getting a bit variable. It's changing a lot more. Now, we can actually plot this out in Workbench. So what we have here is a chart that we've taken from our week on-chain newsletter. You can see that we have our price here in black. We have our long-term holder SOPR, which is that same metric we were just looking at in orange. You can see here's our volatile period. And what we've done is we've calculated the long-term holder spent cost basis. So what that means is for all the long-term holders in the network, on any particular day, what was their aggregate? If you took an average of all of the long-term holders that spent their coins, what is the aggregate or average cost basis for where those coins came from? If they're realizing a 200% profit on a price at 40,000, that means that you've got a cost basis at 20,000, because 20,000 times 2 will give you that 40,000. So what we have in this blue line is that rough or approximate estimated cost basis. And you can see that through all of 2020 and then into 2021, all the way through to May, that cost basis was somewhere on the order of around $8,000. It's a fairly stable baseline. It's showing that most of the coins that were being spent by long-term holders is somewhere around that $8,000 cost basis. What we saw following May, however, is actually it start to rise. Now, this is a subject of two different things. One is that you've got more of these long-term holders who are taking strategic profits. They're taking, coins off the market. They may have accumulated their coins on the way up and they're actually taking some earlier profits. There's a little bit more trading going on. So those coins are coming from a higher level. During the rally higher, you've got more long-term holders accumulating and then taking profits later on in that cycle. Now, the other reason why we see this rising up of the cost basis is that at Glassnode, we use 155 days. It's approximately 5 months to determine what actually classifies as a long-term holder. And there's a statistical reason behind that, but the very simple logic is that the longer a coin is dormant, the more likely it is to stay dormant. So once someone becomes a hodler, they're more likely to stay a hodler. Now, 5 months ago from our current period, we were actually up around the all-time high in April. So if you think about this, 5 months ago when we were rallying higher in February or January, price had never broken above something around 10,000. It would only been there during the very, very late stage of 2017, and it more or less traded below $10,000 for a number of years. So that makes sense to have a cost basis somewhere around 8,000. Once we're over in this current market period, long-term holders now capture everything almost up to the back end of April. So there just is the possibility for long-term holders to own coins with a higher cost basis. So what we have to think about is, what do these metrics, how are they defined? What is their time scale? And what we're actually seeing here is a rising cost basis that may correlate with more trading activity, but it's also showing that long-term holders now exist up in this topping zone, and they actually own coins that were purchased at higher levels. So that's just an interesting little demonstration of how we can use Workbench and also understand what's going on with long-term holders and their cost basis. So next, what we're going to look at is our exchange balances. Now, what we look at in the newsletter is that our percent balance on exchanges has actually declined down to around 13%, which is the lowest level we've seen since February 2018. And we can see also that our net position change has maintained a fairly, it's a red pattern, which is essentially showing that there's outflows. Exchanges are more or less seeing net outflows. We saw an inflow period during the May sell-off, and then that took a little bit of time for the market to find its feet, and then we've resumed this downtrend. And we can see this. We see this net position change move to net inflows. It turns green over that May period as coins flow in, and then investors started accumulating and then started withdrawing. So we're seeing the same pattern playing out. In the report, we actually dive in and look at individual exchanges and how there's a few different characteristics. Some of these exchanges have essentially seen perpetual outflows, the likes of Coinbase and Huobi. They've seen outflows almost the entirety of 2021. What we've seen is another cohort of exchanges which have actually seen coin inflows, the likes of Binance and Gemini being the majority ones. And this is a reflection of a changing dominance, perhaps. It could also show that those exchanges have different services, custody solutions. There's many reasons why we're going to see these changes in these different inflows and outflows. But I would certainly encourage you to jump into our newsletter and actually have a look over some of those different exchanges. And you'll be able to see these interesting patterns between these two different cohorts, where some have seen inflows and others have seen net outflows. But on aggregate, when you sum all of these together, what we're actually seeing is a fairly substantial outflow of coins. And what we need to look at over the next coming weeks, now that we've had a little bit of downside price action, does this trend actually start to reverse? Do we get a repeat of May 2021? Or does the market continue to find strength and this trend actually continues back to the downside, showing that outflows are dominant? Now, lastly, what I want to touch on is actually in the mining space. So in our report, we talk about miner unspent balances. We talk about some of the general hodling behavior that's going on in the mining market. The mining industry is certainly evolving. They've got more options for financing. They've got more options for hodling their coins. There's some miners who explicitly hodl their coins, and we're seeing geographies where these miners are located continuing to shift. So I'll implore you to, again, go to the newsletter to really observe what's going on in those balances and the recovery of hash rate. But what I really want to focus on in this session is actually this interesting metric called the Thermocap. Now, what the Thermocap is, for every 10 minutes when a block is mined, there's a block reward and there's fees. Now, if we think about over the lifespan of Bitcoin's history, on every single block, let's assign a price and a value, a US dollar value, to that block reward. Now let's imagine that over a period of, say, a year, there's $1 billion worth of rewards. Then it can be reasonably expected that miners, as a competitive industry, are going to spend up to $1 billion to earn that $1 billion. If they spend $1 shy of that, then that means there's $1 profit. So if there's a profit motive, people are incentivized to spend that money to obtain that reward. So what the Thermocap does is it looks at all of the block rewards throughout Bitcoin's history, and it essentially assigns that dollar value at the time when it was mined and then sums it all together. So if you think about this, it's essentially the total lifetime value that Bitcoin has paid miners, the maximum amount that could possibly have been paid to miners in US dollar terms. Now, if we assume that miners are rational actors and they're not going to burn money for no reason, there has to be a profit motive behind what they're doing, otherwise they go out of business, we can consider the Thermocap, this cumulative sum of value that Bitcoin has paid, as almost an upper bound on the maximum amount of investment that could possibly have gone in to obtain that reward. And what we're seeing is that it's currently reached a point of $30.3 billion. So Bitcoin has paid miners through its entire lifespan $30.3 billion. And that means that the cost of production for the entire coin supply, all 18.8 million BTC, is somewhere on the order of $30.3 billion. So it's almost that input cost. What is the cost of production? So to close out this session, I want to touch on this model called the block subsidy model. Now, what we've done here is we've got our market cap here in gray. We've got our Thermocap down here in orange. And then what we've done is we've multiplied that thermocap by 2, by 6, by 32, and by 64. Now these are arbitrary numbers. We can change these to whatever you can see. You can see I've actually turned off our 4 and our 16, but more or less what we're seeing here is this is our cost of production in orange. And what I want you to notice is that it actually caught the bottom of the first 2011 bear market. Then what we saw is Bitcoin went on a bull trend. It reached the top twice, somewhere between 32 and 64. So it's saying that the cost of production is X and the total market value is 64 times that value. So it's showing that it is, as a mean reversion line, price has run away from that cost of production, that call it a fundamental valuation metric. It's demonstrating that there's a level of overblown. So we get this blow off top somewhere between 32 and 64 times the thermocap. Then the market enters a bear. And note how it actually bottoms on the pink line, which is 2 times the thermocap, or 2 times the total cost of production for the circulating supply. Now, there's another way to think about this. If the cost of production is, in inverted commas, the intrinsic value or the imbued value by the energy cost and the mining hardware, then in theory, bottoming out at a level of 2 times that is almost analogous to a monetary premium. It's a value that the network has, or a return on investment from the total input costs. So we can see that the 2015 bear really bottomed out on 2 times that thermocap, representing a 2 times or a monetary premium of 2x the cost of production. The cycle then repeats. We had our bull market trend. We topped out again at 64 times the thermocap. The market sold off, and then it came back and found support in 2018 and 2019 on 6 times the thermocap. So it's showing that we've now actually multiplied that monetary premium we had back in 2011. We've multiplied it by 2, and then it's multiplied by 3. And note how it actually caught the March 2020 sell-off as well. So we had a number of points when we actually tested and found this 6 times the cost of production floor price before we rallied again. So note that we also have a topping model. It's some kind of pricing model or evaluation that's showing this is the total input cost in the thermocap. When has price rallied too far away from that input cost of production? And also that over time, we're seeing a potential bottom forming on these increasingly high monetary premiums, showing that essentially the network has developed a return on investment equivalent to some magnitude. So we're showing that the Bitcoin network is actually growing in monetary value and that it's actually worth more than the input cost of production in total. So thanks for tuning in. Hopefully you found that useful. I really enjoy playing around in Workbench. I think anybody who's looking at these videos, this is a nice model, building up this block subsidy model as an exercise to actually build up how this is set up together. So what we've essentially done is done 2 times our thermocap. You can see that our thermocap is M2, and this is very simply 2 times that value. And then all of these are assigned to our Y1 axis alongside market cap. So as a useful exercise for anybody who's just getting involved in Workbench, this might be a useful task and a tool to actually be looking at. So thanks for tuning in. Hope you enjoyed this session, and I look forward to seeing you next week. Cheers.